Hi there, accountants. I hope all is well, and I pray that as you are viewing this video that you're in the best of health and spirit. This video will cover Chapter 12, Investments, and in this chapter, we'll learn about the various approaches that we use to account for investments that companies make in debt, securities, as well as equity securities of other companies. So corporations raise funds to finance their operations by selling equity securities, which as we see here are common in preferred stock, and debt securities, which are bonds and notes. So these securities are also called financial instruments, and they're purchased as investments by individual investors, mutual funds, and also by other corporations. So in later chapters, we discuss equity and debt securities from the perspective of the issuing company. But the main objective of these financial instruments is to earn a return from the dividends or interest that the security pays or from increases in the market prices of the securities, in addition to develop a relationship with the affiliates of those whose companies the securities are acquired. So, one key thing to think about is essentially if you ever bought a certificate of a deposit. So, it's also referred to as a CD. So, if you invest in what's called a debt security, then what is happening is that you're essentially lending the bank money, right? And when you lend the bank money, so essentially, for lack of a better word, it's like you're forced to keep the money in this CD for a number of period of time, right? It could be for 6 months, it could be for a year, 2 years, etc. But the key thing is when your money is in the bank, it's sitting there, but at the same time, from the bank's perspective, they are using the money and investing it to make more money on the money. So with debt security, there's a specified date for when it matures. There's a face amount that's paid to investors when it matures. And in the meantime, interest is paid to the investors. So in this example, we look at the example of a debt investment. So we start off learning about debt securities. So we have bonds, right? In bonds, that's essentially when an individual, they lend money to a corporation. So here in this example, we have on July 1st, 2024, Masterwear Industries issued $700,000 of 12% bonds dated July 1st. So based on this information, it simply states that Masterwear promises that as they borrow this $700,000, in addition, they are going to pay 12% interest per year. So here it states interest of $42,000 is payable semi-annually on June 30th and December 31st. The bond matures in 3 years on June 30th, 2027. United Intergroup Inc. purchased the entire bond issue on a date when the market interest rate for the bonds of similar risk and maturity was 14%. So one of the first things we want to do is to calculate, well, what is the price of the bonds? So before we get there, one key thing that I want you to keep in mind is here we see Masterwear promises to pay 12% interest, but we see that the market interest rate for bonds of similar risk and maturity is 13%. So let's think about it from the perspective of an investor, right? So if you want to invest your money, you want to make the most possible. So in a situation like this, what happens is the corporation needs to issue the bonds at a discount, right? Because when we think of it logically, if I can invest my money into the market and they'll give me 14%, but this company is only guaranteeing 12% interest, the demand for the 12% bond in comparison to the 14% bond is going to be lower. And much like in our everyday life, a great example would be retail, right? If the winter is coming up, summer items are going to be in less demand because people are preparing for long sleeves. They are preparing for coats and things of that nature. So, whenever the demand is low, there is a discount. Similar to our everyday life, it's the same thing that's happening. So, whenever the stated rate, the promised rate of interest is lower than the market rate, the bonds are issued at a discount. So in this case, we see interest of $42,000 is payable semi-annually. So we multiply the interest by the present value of an ordinary annuity. And then we essentially use the present value again of an ordinary annuity of a dollar table, because again, here we see it's 12% bonds. It lets us know that the payments are made semi-annually. So we essentially divide it by two. Reason being is because it's being paid every 6 months, twice a year. So we cut this in half, 12% divided by two, and then the bonds mature in 3 years, which will essentially be divided by two as well. So anytime we are considering the payments, I apologize. Here it states the maturity was 14%. So the interest is essentially based on the market rate. So the market rate, which is 14%, that is cut in half, all right, to determine the interest expense. And then from there, we also need to factor in the number of periods. So the bonds mature in 3 years. And since we are making payments twice a year, we multiply 3 by 2. And in this case, when we're using the present value of an ordinary annuity table, we use the market rate, which in this case is 14%, and we divide it by 2, which gives us 7%. So based on the present value of an ordinary annuity table, the factor is 4.76654. So we multiply it by the interest payments. And then the principal face amount, which is $700,000, we use the present value of a dollar table. Again, we use the same number of periods. It's 3 years multiplied by two, since the payments are semi-annual. And the interest is 1/2 of the yearly interest of 14%. The market interest rate, which is 14, we divide it by two, again, because the payments are made semi-annually twice a year. So when we add these present values up, the present value, the price of the bonds is $666,633. So again, whenever the stated rate is less than the market rate, in such case, the bonds are issued at a discount. So, to determine the issue price of the bonds, it's very important. We need to understand how investors compare the bond's stated rate with the market rate. So, as just pointed out, whenever the interest rate that's paid by the bond is higher than the market rate, investors are willing to purchase the bond for more it is. So, it's sold at a premium. And whenever the bond's stated rate is lower than the market rate, then investors are willing to purchase the bond only at an amount less than its maturity value. So that's what's called a discount. So again, think of it in our everyday life. Whenever the demand is low, items are sold at a discount. And whenever the demands are high, items are sold at a premium. So same logic applies. So when it comes to recording the purchase of a debt investment, this would be our journal entry. So the company would debit the investment in bonds for the full face value, which in this case is $700,000. And again, investment in bonds would be reported on the balance sheet as an asset. We would credit the cash account because, again, cash is being paid. So we credit the cash account for $666,633, and we will credit the discount on bond investment. So whenever a debt investment is purchased, it's recorded at its cost. So that's essentially the total amount paid for the investment plus any brokerage fees. So this is essentially how the journal entry would be reported. So because United, they purchased the bonds for an amount less than the face amount, it credits this account, which is the discount on bond investment, for the difference. So the discount on bond investment is basically a contra asset account. And it basically is utilized to reduce the carrying value of an investment. So we know in accounting, all accounts have a normal balance. And a normal balance is essentially the side on which an increase is shown. So whenever we have a contra account, we can have a contra asset account, a contra liability account, a contra equity account. So in these examples, it's essentially used again to record the historical cost, and then from there, it offsets the balance. In this case, it offsets the carrying value of the investment in the bonds. So if United instead, let's say they purchased the amount for $725,000, that's obviously higher than the face amount of the bond. So instead, they would debit the premium on bond investment, and that would assist with recording the investment at its cost at the date of purchase. So as they have these bonds, they need to account for interest revenue. So United is going to record interest revenue using what's called the effective interest method. So with the effective interest method works. So we know from the previous information, Masterware's bonds has a stated rate of 12% semi-annually. So what this basically means is that every 6 months, twice a year, United is going to receive $42,000 in cash from Masterware, right? How do we determine that amount? So it's the face amount of the bonds, which is $700,000, multiplied by the stated rate, which is essentially the promised rate of interest by the corporations. So in this case, it's the face amount multiplied by the stated amount, right? Divided by 2. Why are we dividing it by 2? Because the payments are made semi-annually twice a year. So for the entire year, we're paying $84,000 worth of interest, but we are dividing it by 2 because payments are being made twice a year. So this $42,000 represents the interest received. But in regards to the interest revenue, it's the outstanding balance or the carrying value, which is multiplied by the market rate of 14% divided by 2. So keep in mind, United purchased the $700,000 bonds at a discounted amount. So why would they be able to pay less than $700,000 in value for the bonds? And again, the market rate of interest for the bonds was 14%. So therefore, if the demand is low, there has to be a discount. So in such case, we need to account for the interest revenue. And as we see here, it's the carrying value or the outstanding balance multiplied by the market rate. And then we divide it by 2. So our journal entry would be as follows. We received cash of $42,000. We debit the discount on bond investment. So we are amortizing the amount that's in a discount on bond investment. And we credit our revenue account. So the journal entry that we're recording, again, the key thing is that we want to amortize the balance and the discount on bond investment because at the end of the 3-year period, we want the carrying value of the bonds to reflect the face amount of $700,000. So here we see an example of the amortization schedule. So this is the amortization table that'll be used for the Masterware bond. So it shows the interest being recorded at the effective rate over the life of the investment. So as we can see, amortization of the discount, it gradually increases the amortized cost of the investment. And this is, again, until the investment reaches its principal amount. The face amount, which is $7,000, and that represents the amount that's going to be received when the debt matures at the end of the 3-year period. So if the bonds were instead purchased at a premium, there's a similar amortization schedule that basically reduces the premium over time until the bond's amortized cost reaches the face amount of $700,000. So whether the bond is issued at a premium or it is issued at a discount, the key thing is that the discount or the premium is going to be reduced. It will be amortized over time, again, until the bond's amortized cost reaches the face amount of the maturity, the face value, the principal amount. So here we see the amortized cost or the carrying value or the outstanding balance as of July 1st, 2024 was the amount that was paid, $666,633. And then at the end of the 3-year period, we see that the amortized cost, aka the carrying value, aka the outstanding balance, is $700,000. All right. So cash interest, $42,000 was paid every 6 months semi-annually. So they made cash payments of $252,000. And then based on the effective interest, as we see, The effective interest based on the market value was 285,367,000. So therefore, we had to account for the amortization of the discount that was originally granted to the bondholders. So there's three classifications of debt. So as we look at this illustration, we essentially have these various approaches depending on the type of debt investment. So we have what's called held to maturity. This is essentially when we have debt for which the investor has the positive intent and the ability to hold it until maturity. We have trading securities. All right. And just keep in mind, held to maturity is often referred to as HTM. Trading securities referred to as TS. This is used for debt that is held in an active trading account for immediate resale. And we have available for sale. This is used for debt that do not qualify as held to maturity or trading. All right. So the key difference among these reporting approaches is basically how are we going to account for any unrealized holding gains and losses, right? So one thing that we know is that there's changes in the fair value, right? It basically depends on how the bond is doing, what the market rate is and things of that nature. So accounting for changes in fair value, it depends on the classification on the debt investment. So as shown here, again, one of three. HTM, held to maturity, trading security, TS, or available for sale, AFS. So one of the reasons why we have to account for the changes, the unrealized holding gains and losses differently depending on the type of investment is because, again, one of the primary purposes of accounting is we want to provide information that's useful to the decision makers. So what's most relevant for that purpose is not necessarily the same for each investment that a company might make. So let's say, for example, if a company invests in corporate bonds to have a steady return on investment until the bonds mature, then in such case, the fair value doesn't really matter, right? Think of it in your everyday life. If you purchase stocks in a company, even though there's an increase, there's a decrease, you kind of don't care because it's like you're holding it until maturity, right? Same thing with a bond. Yes, there's fluctuations in the rate, the market rate, but again, you're holding it until maturity. So it doesn't necessarily matter. But on the other hand, if the company wants to invest in the same bonds because it wants to sell them at a profit in the near future, in that case, the day-to-day changes in the fair value could be viewed as relevant because obviously that will determine when they're going to sell. So under held to maturity, unrealized holding gains and losses are not recognized, and it's carried on the balance sheet at the amortized cost. Under trading securities, the reporting approach is that it is recognized in net income, and therefore it's also recognized in retained earnings as a part of shareholders' equity. And for trading securities, they are reported on the balance sheet at fair value. Next, we have available for sale. And available for sale, treatment of unrealized holding gains and losses are recognized in what's called OCI, other comprehensive income, and therefore in accumulated other comprehensive income in shareholders' equity. And much like trading securities, available for sale debt investments are reported in the balance sheet at fair value. So this is an example of General Motors and their disclosure about investments. So this provides a description from an annual report of how General Motors accounts for investments in marketable securities. So it says, note 2 in part, significant accounting policies, marketable debt securities. We classify marketable debt securities as either available for sale or trading. Various factors, including turnover of holdings and investment guidelines, are considered in determining the classification of securities. Available for sale debt securities are recorded at fair value, with unrealized gains and losses recorded net of related income taxes in accumulated other comprehensive loss until realized. Trading debt securities are recorded at fair value, with changes in fair value recorded in interest income and other non-operating income net. So why is this important? Again, this is relevant information to decision makers. Hence, there is a note. All right, so unrealized holding gains and losses are less important if sale before maturity isn't an alternative, right? Because again, those gains and losses, they're never going to be realized by a sale. So for this reason, if an investor has the positive intent and ability to hold the securities to maturity, investments in debt securities are typically classified as HTM, held to maturity, and therefore reported at their amortized cost or their carrying value. So a debt security can't be classified as held to maturity if the investor might sell it before maturity, in response to what's happening in the market. So maybe there's changes in the market prices or changes in interest rates, or they want to meet the needs of liquidity. So again, liquidity as it is defined in accounting is how fast you can turn an asset into cash, or maybe other factors. So these are one of the key things to keep in mind. If they might sell it before maturity, then in such case, a debt security cannot be classified as held to maturity. So here we have an example. All right. So let's say that the checking market, but as we check the market prices, we have Wall Street Journal, and it indicates that the fair value of the Masterwear bonds on 12/31/2000 year 24 is 714,943. How is United going to account for this increase in fair value? That ultimately depends on how the debt securities are classified. So, as we saw in the previous example, right? Those bonds have an amortized cost of $671,297. So, how we get that? So, what that basically means is that there's an unrealized gain of $43,646 of the difference. So if they view the bonds as held to maturity, then it's ignored, right? Because again, it doesn't matter how the market fluctuates. We plan to hold it until maturity. So the investment is basically just going to be reported on the balance sheet at the amortized cost, at the carrying value of the bonds. It will not recognize any fair value changes when it is considered held to maturity. So in this example, we have a sale of held to maturity investments. So typically, held to maturity investments are, again, by the naming itself or the classification itself, it's held to maturity. But let's just say that there's a unforeseen circumstance and a company decides that they want to sell the debt investment, in this case for $725,000. So in such case, they'll basically record the sale just like the sale for any other asset. They'll record a realized gain or loss, and that's determined by comparing the cash that's received with the carrying value, which is equivalent to the amortized cost of the asset that is sold. So in this case, we received $725,000, so we debit cash. We credit the investment of bonds for the initial face value at which it was reported, $700,000. And then from there, in order to determine the ending balance of our discount on bonds and investment, it will be calculated as follows. There was a balance of 33,367, and we've amortized $4,664 thus far. So the remaining balance in this contra asset account is 23,703. So to zero out the balance in our discount on bond investment, we have to debit it. And the difference between the two represents the gain on sale of investments. So there's one important exception to the general rule that companies don't recognize unrealized gains and losses for HTM, held to maturity investments. So if viewed as a held to maturity investment, companies likewise are required to use what's called the current expected credit loss CECL model to account for credit losses on held to maturity investments. So this basically requires companies to make an estimate of the amount of interest and principal payments that they won't receive in the future. In addition, companies account for this estimate by recognizing a credit loss in net income and reducing the carrying value of the held to maturity investment with an allowance for credit losses. So as it relates to our held to maturity securities. So our held to maturity securities appear in the financial statements as follows. So in the income statement and the statement of comprehensive income, the realized gains and losses are shown in net income in the period in which the securities are sold. Unrealized holding gains and losses are disclosed in notes to financial statements. And again, realize there's a difference. Realized means that it will be recognized, and unrealized means that, there's an increase, but it's not necessarily recognized for accounting or taxation purposes. And our held to maturity does not affect our other comprehensive income. As it relates to the balance sheet, our investments in held to maturity securities are reported at the amortized cost, aka the carrying value. All right. And it's less any allowance for credit losses. The fair value of the investments are disclosed in the notes to financial statements. For our cash flow statements, the cash flows from buying and selling held to maturity securities are classified as investing activities. So we know with our cash flow statement, we have financing, we have investing, and we have operating activities. So our debt securities that are classified as held to maturity are considered investing activities. So this essentially provides an illustration of reporting held to maturity investments. And again, this is basically just an example, a further example of the transaction that we referred to earlier. So now we move on to trading securities. So some companies, primarily, financial institutions, they actively and frequently buy and sell securities. Why? Because again, they want to earn profits on short-term price fluctuations. A lot of people that invest in the stock market, this would be like a day trader, right? They basically want to buy low, sell high, right? So same concept, essentially. So investments in debt acquired primarily for the purpose of selling them in the near future, that's classified as trading securities. So the holding period for trading securities, it can be measured in hours, days, rather than months or years. These investments, they're typically reported among an investor's current assets. So we know that current assets are essentially those that are expected to be used up or consumed within a year. So usually only banks and other financial operations invest in securities in the manner and the purpose, to be categorized as trading securities. So much like held to maturity investments, trading securities, they're recorded at cost when we purchase them, right? How much do we pay for them? And then any discount or premium is going to be amortized to interest revenue over time as those periodic interest payments are received. So the interest payments can be made semi-annually, they can be made annually, but for the most part, they're generally issued semi-annually. So in subsequent periods, there are two important differences between our trading securities and our held to maturity securities. So trading securities are written up or down based on a fair market value, or it's marked to market and in the balance sheet. But we know held to maturity securities are kept at the amortized or the carrying value. And any corresponding unrealized holding gains and losses on trading securities, they're included in net income on the income statement. Held to maturity securities, on the other hand, they don't include any unrealized holdings, gains, and losses in the net income. So that's one of the key things to keep in mind. When we're reporting for trading securities at their fair value, it's basically, us accounting for the amortized cost, but more so reflecting the current fair value. So again, When we have trading securities, this is more relevant, right? Because again, we're planning to sell it in the near future. So changes in the fair value, this basically provides an indication of management's success in deciding when to acquire the investment, when to sell it, whether they need to invest in fixed or variable rate securities, and also whether they should invest or long-term or short-term securities. So for that reason, again, think of it from an investor's perspective. So in such case, whenever we're dealing with trading securities, it makes sense to report any unrealized holding gains and losses, during a period that fair values change. So even though the gains and losses haven't been realized, they would ultimately have an impact on a financial statement user's decision. So unlike held to maturity securities, as we mentioned, trading securities are carried at the fair value on the balance sheet. So what that simply means is that the carrying value needs to be adjusted to the fair value by the end of every reporting period. So that reporting period might be a month, it might be every quarter, every 3 months, it might be semi-annually, every 6 months, or it might be annually, every 12 months, right? So a lot of companies, they adjust trading securities to fair value at the end of each day, right? So rather than increasing or decreasing the investment account itself, we have a valuation allowance, fair value adjustment to increase or decrease the carrying value of the investment. So at the same time that we record the unrealized holding gain or loss that's included in net income, right? Again, we have to remember that the gain or loss is unrealized because the securities haven't been sold, but we are accounting for the change in value. So in this case, for Masterwear, the bonds have a fair value of $714,943 as of December 31st, 2024. And the table shows the calculation of the difference. So the amortized cost is $671,297, and the fair value is $714,943. So the difference between the amortized cost, the carrying value, versus the fair value is $43,646. So therefore, we need to account for the difference. So to do such, we debit our fair value adjustment and we credit our gain on investments unrealized net income. So here we have an example. Let's say United decides to sell the bond for $725,000. So let's assume that United sells the bond for $725,000 on January 5th, 2025. So in order to account for this sale, United needs to do two things. First, they need to update the carrying value because, again, there's a difference between the amortized cost, the carrying value, versus the fair value. And then they need to record in net income any unrealized holding gains and losses that occurred during 2025 up to the date of sale. Second thing they need to do is that on the date of the sale, United needs to record the receipt of cash and remove the amounts that's associated with the investment from the relevant balance sheet account. So the first thing we do, we adjust the trading securities to the fair value, right? And again, the beginning balance was the $3,646 as of 12/31. And then again, the fair value when we sell it is $725,000. So the difference is $53,703. So therefore, we need to account for the difference. So therefore, the difference between the $53,703 and the balance as of 12/31, 2024 is $10,057. So we record the journal entry, we debit the fair value adjustment for $10,057, and we credit our gain on investments, unrealized net income for $10,057. So now the next step is we need to record the sales transaction. So After making the previous journal entry, again, we accounted for the difference. Now we essentially need to ensure that, you know, we're recording the sale transaction correctly. We know that the amortized cost, the carrying value, is different from the fair value. And since this is a trading security, we need to report the trading securities on the balance sheet at its fair value. So that is what we accomplished with the first journal entry. So now in this journal entry, we account for the sale. So much like with the sale of the held to maturity investment, we're receiving $725,000 in cash. Accounting is accounting. The logic remains the same. Whenever there's an increase to our cash or any asset account, we must debit it. So we debit cash for $725,000. We know that the value of the investment of bonds is $700,000, so we credit that amount. And then we need to account for the fair value adjustment, which is the 53,703, again, which is the difference between the fair value and the amortized cost / the carrying value. So we credit the fair value adjustment. And then from there, we account for the discount on bond investment account. And again, it is similar to how we calculated it previously. It represented the amortized cost when we initially acquired the bonds minus the amortized cost thus far. So therefore, our total debits equals our total credits. So here it's asking, well, what happens if the company doesn't update, the fair value adjustment? So as noted in FASB ASC 320-1040, so for expediency, companies may not update the fair value adjustment to fair value as of the date of sale before recording the sale. So in our example, the fair value adjustment balance was $43,646 on December 31st. So United would record the following sale entry on January 5th. So we would account for the journal entry that we did not yet make. So we debit cash for $725,000. That doesn't change. We debit the discount on bond investment because, again, we want to zero that account out, and it represents the original discount on the bond investment minus the amount that has been amortized to date. So we have that difference of $28,703. We credit our investment on bonds for the principal amount. We credit the fair value adjustment for the amount that's already reflected in the account. And then from there, we account for the increase in the value. We do that by crediting the gain on trading securities net income. And then again, if we think of it logically, the total of the fair value adjustment plus the gain on trading securities, that equals the $53,703. So as it relates to our trading securities, they appear in the financial statements as follows. So we have the income statement and statement of comprehensive income. So gains and losses are included in the income statement in the periods in which the fair value changes, regardless of whether they are realized or unrealized. So again, unrealized basically means that the instruments, the financial securities have not yet been sold, but there was a fluctuation in the market price. And it does not affect other comprehensive income. On the balance sheet, investments in trading securities are reported at fair value, typically as current assets. And again, current assets are those assets that we expect to use up or consume within a year. Then we have the cash flow statements. So cash flows from buying and selling trading securities, they are not classified as investing activities. Instead, they are classified as operating activities because trading securities is a normal part of operations. Again, here is just an illustration of how trading securities would be reported. So this brings us to the last classification, debt investments classified as available for sale. So available for sale securities aren't held for trading or designated as held to maturity. So the investment is available for sale. Much like trading securities, available for sale securities are in the balance sheet at fair value, the unrealized holding gains and losses are not included in net income, but instead they're reported in the statement of comprehensive income as OCI, which stands for other comprehensive income. Right? So, because available for sales, they might be held for multiple reporting periods. One could argue that, there's sufficient time for unrealized holding gains in some periods to balance out with the unrealized holding losses in other periods. So, essentially, included unrealized holding gains and losses in income each period, that would basically kind of confuse investors. So, it would make income appear more volatile than it really is over a longer period. So, in such case, with our available for sale investments at fair value in a balance sheet, they do not record in net income the unrealized gains or losses that's associated with the changes. Instead, they basically show the unrealized gains or losses in other comprehensive income as they occur, and then it's only included with the realized gains or losses in net income when they actually sell the investment. So here we have this example, and let's just say, that the bonds are classified as available for sale December 31st, 2024. And then, there's the semi-annual payments, and the fair value of the bond investment is 714,943. The amortized cost, aka the carrying value, is $671,297. So the difference between the two is $43,646. So therefore, we debit the fair value adjustment account. And this is similar to trading securities, but for our credit, instead of crediting gain on investments, unrealized net income, in this case, we are crediting gain on investments, unrealized OCI, other comprehensive income. So now, much like the trading securities, we need to first update the fair value. So when we're selling available for sale investments, again, we need to account for the fair value, the change in fair value. So similar to our trading securities, the amortized cost, aka the carrying value, is $671,297. The fair value is $725,000. So the difference between the two is $53,703. So the ending balance in our fair value adjustment account needs to be $53,703. So think of it like a bank account, right? You need to pay a bill, and the bill is $53,703. You already have $43,646 in the bank, right? So now, how much more money do you need to deposit? In such case, we need to deposit the difference between the two, which is $10,057. So our journal entry would be as follows. We would debit fair value adjustment for $10,057 and credit gain on investments, unrealized OCI. And now the second step, when we sell the bond, we would need to reverse the previous fair value adjustment. So United, right, as we see in the example, they recorded changes in fair value over the life of the investment. So if we now sell the investment, the effects of those fair value changes, they need to be reversed. So United reverses the previous unrealized holding gains that's included in other comprehensive income. And they simply do this by debiting a reclassification adjustment to OCI for the same amount. And similarly, the account balance of the fair value adjustment is eliminated. So simply stated, after this journal entry is recorded, the fair value adjustment account should have a zero balance. And also, after the reclassification adjustment is closed to AOCI, all of the unrealized gains that's associated with the investment, they would have essentially been removed from the AOCI, right? So then it would basically be as though no accounting for the unrealized gains or losses ever took place. So now once we have, the actual sale, or we went through steps 1 and step 2, now the final step is to record the sale transaction. So all of the unrealized holding gains and losses and the fair value adjustment has been basically cleared away. It's been zeroed out. So the final step is to plug for the realized gain or loss. So this entry is basically the same entry that we made to record the sale of investment under the held to maturity approach. So much like with the held to maturity investment, no gain or loss is recognized in net income over the life of the investment. So instead, the entire gain or loss is basically recognized in net income at the time of the sale. So one of the key differences between the held to maturity and the available for sale is that the unrealized gains and losses are recognized in the other comprehensive income prior to sale. And that basically requires investors to remove any amounts that have been reported and included in OCI and basically recognize them in net income when a sale actually takes place. All right. So that's essentially why the process is called reclassification. So much like with the held to maturity investments, companies, they're required to account for any impairments of available for sale investments, right? But the accounting obviously becomes a little more complex. So if the fair value is less than the amortized cost, impairment exists. Accounting for the impairment depends on management's belief about whether it's going to sell the investment. So, if management intends to sell the investment or believes that it's more likely than not that it will have to sell it before fair value recovers, then the available for sale investment is written down to its fair value and an impairment loss is recognized in net income. If management doesn't intend to sell the investment and doesn't believe that it's more likely than not that it's going to have to sell the investment before the face value recovers, the management is basically required to estimate, right? They're required to estimate and recognize the credit loss, and from there, reduce the carrying value of the available for sale investment with an allowance for credit loss. So with our available for sale securities, they appear in the financial statements as follows. So in our income statement and statement of comprehensive income, gains and losses are shown in other comprehensive income in the period in which the changes in fair value occur. These amounts are reclassified out of other comprehensive income and then recognized in net income in the period in which the securities are sold. For our balance sheet, investments and available for sale securities are reported at fair value. Any unrealized holding gains and losses become part of AOCI and shareholders' equity and are reclassified out of the AOCI in the periods in which they're sold. And then anytime we have these cash flows from buying and selling available for sale securities, these are classified as investing activities. So this would be an example of how it would be reported for available for sale securities. And then here we just basically have an example from Cisco. So individual securities that are available for sale are classified as either current or non-current assets, depending on how long they'll likely be held. So this is an example from Cisco Systems and how they basically summarize the available for sale debt investments. And these amounts are in the millions. So here with this example, we basically have a side-to-side comparison that highlights some of the key aspects of these accounting approaches. So first column, we have held to maturity. Second, we have trading sale. And third, we have trading sale. So with no regard to which classification, it is, purchasing bonds at a discount, the journal entry is always going to remain the same. We debit the investment account, we credit the discount account, and we credit cash. So it's the same for all three: held to maturity, trading securities, and available for sale. Next, we record the interest revenue. And for the interest revenue, the journal entry is the same for trading securities and same rather for available for sale. So we debit cash, We debit the discount because we're amortizing it, and we credit the interest revenue. So whenever we have to adjust the fair value, again, because we are holding it to maturity, the ups and downs of bond doesn't really matter to us, right? So it would be no entry. Under the trading securities, we would account for the fair value adjustment. And then there's a special account called gain unrealized net investment. Under available for sale, we would debit the fair value adjustment and we would credit unrealized other comprehensive income. And then when we sell the bond held to maturity, there's no entry, but we need to account for the increase in fair value the same way. We would debit the fair value adjustment, and then we would credit unrealized net income for trading securities, and we would credit unrealized other comprehensive income for available for sale. For step 2, whenever we need to reclassify unrealized holding gains or losses under held to maturity, there's no entry. Trading securities, no entry. But for available for sale, we need to reclassify as mentioned. So we would reclassify the other comprehensive income and we would credit our fair value adjustment account. And then lastly, when we, sell the bond, this would be our journal entry based on the various approaches. So here we see transfers between reporting categories. So at each reporting date, the appropriateness of the classification, is basically assessed. We need to determine, is this still, held to maturity, or is this trading? Is this trading, or is it held to maturity? Is this held to maturity or available for sale, etc.? So for instance, let's say an investor no longer has the ability to hold certain securities to maturity, and now they want to hold them for sale. These securities are going to be classified from held to maturity to available for sale. So whenever a security is reclassified between two reporting categories, the security is transferred at its fair value on the date of the transfer. And then if there's any unrealized holding gain or loss at reclassification, it needs to be accounted for, right? And it needs to be accounted for in a manner that's consistent with the classification for which the security is being transferred. So here's how it's accounted for under IFRS, International Financial Reporting Standards. So under IFRS number 9, transfers of debt investments between the amortized cost, aka the carrying value, and the FVOCI and FVPL categories occur if and only the company changes its business model with respect to the debt investment. So obviously there's some changes between US GAAP and IFRS. So GAAP allows a fair value option, which is FVO, and that basically permits companies to elect to account for most financial assets and liabilities at fair value. So that's under GAAP. So under the fair value option, held to maturity and available for sale investments, they're shown in the balance sheet at their fair values, and any unrealized gains and losses, they're recognized in net income in the period that they occur. So this accounting approach is basically the same approach that we use for trading securities, but unlike the trading securities, purchases and sales of investments are accounted for under the fair value option. They're likely to be classified as investing activities on the statement of cash flows. And again, the reason being is because they're not held for sale in the near term. So therefore, they're not operational in nature. So as it relates to the fair value option, international accounting standards, they're essentially more restrictive than US standards for determining when firms are allowed to elect the fair value option. So under IFRS number 9, companies, they can only elect the fair value option in specific circumstances. So as it relates to the financial statement presentation and disclosures, trading securities, held to maturity securities, and available for sale securities, they're either current or non-current depending on when they are expected to mature or be sold. So investors, they should disclose the following in the disclosure note: the aggregate fair value, the gross realized and unrealized holding gains, the gross realized and unrealized holding losses, Any changes in net unrealized holding gains of securities. And then lastly, any amortized cost basis by major security type. So here we basically have an example of what a fair value disclosure would look like. And this is for HP Incorporated. And it basically shows the available for sale and the fair value measurements. So we essentially discussed debt investments. And now we start to look at equity investments, right? So there's critical events over the life of an investment in equity of another company. So such as shares of common stock, and they include purchasing the equity security, receiving dividends for some equity securities, holding the investment during the period, for when there's changes in the fair value. Thus, obviously, there will be unrealized holding gains and losses since the security has not yet been sold. What happens when the investment is sold, and from there we will have realized gains and losses. So in addition, equity investors, they get to vote on key decisions that's made by the company, so they get to decide who's going to serve on the board of directors. So each share of common stock basically gives a person a vote. So if an equity investor has enough shares, then that investor, they basically have enough votes to influence the operation. So therefore, as it relates to accounting for equity investments, we also need to consider what is the extent to which the investor can influence the activities of the investee. So as it relates to our equity investments, there are some characteristics. And then based on the characteristic, there are various reporting methods. So if the investor doesn't have significant influence over the operating and financial policies, this is typically when they own less than 20% of the voting stock. So in the case where they own less than 20%, the reporting method is the fair value through net income. So this is similar to the trading securities approach that's used for debt. Investment is reported at fair value with unrealized holdings, gains, and losses included in net income unless the fair value can't be determined. If the investor has significant influence, this is typically when they own between 20% and 50% of the voting stock. So in such case, the equity method is used. And this is when the investment is reported at cost adjusted, for investors' share of any subsequent earnings and dividends of the investee. Whenever the investor controls the investee, and this is when they own more than 50% of the voting stock, then from there, the financial statements are consolidated. And then, the investee and investor, there's basically reported as a single company. It's combined. So when the investor lacks significant influence, again, this is when they own less than 20% of the voting shares. So here we have this example, and this is to record the purchase of an equity investment, right? So simply, it's basically just exchanging one asset for another. So it's a transfer of assets. We had cash of 1.5 million. We spent it to purchase investment in equity security. So that would be our journal entry. And then the investment, the dividend revenue, we would debit our cash because there's an increase of cash, and we would credit our dividend revenue account. So as it relates to adjusting the equity investments to fair value, so the cost was 1.5 million. The fair value is $1,450,000. So therefore, there needs to be a fair value adjusted balance of $50,000. There was a decrease. So therefore, the fair value adjustment had a beginning balance of 0. The balance needed as of December 31st, 2024 would be 50,000. So therefore, we need to credit our fair value adjustment account to account for the decrease in value. And this would be our journal entry. we would debit loss on investments, unrealized net income, and we would credit our fair value adjustment account. So if we were to sell the equity investment, our journal entry would be as follows. So let's say the cost is $1,500,000 and the fair value is $1,446,000. We need to account for the balance. So the balance as of 1/1/2020, year 25, was 50,000. And we see that there's a difference between the cost and the fair value of 54,000. So therefore, again, think of it like a bank account. We need an ending balance of 54,000, and we already have 50,000 in the bank. So it simply means that we need to deposit 4,000. So therefore, our journal entry would be a debit to loss on investments, unrealized net income for 4,000, and we would credit our fair value adjustment. And then from there, to record the sale, we would debit cash for the fair value, 1,446,000. We would credit the investment equity securities, which represents the cost. And then from there, we would debit the fair value adjustment account, because again, this account balance needs to be zeroed out. So let's just say United didn't sell the investment during 2025. What it would simply do is just keep recording whatever fair value adjustment is necessary to carry the investment at fair value in the balance sheet. So let's just say in this example, the value decreased to 1.3 million. Same logic, right? There's a difference of 200,000 at the end of 2020, year 5. We need an ending balance of 200,000. We already have a balance of 50,000. So therefore, we need to account for the difference. So there needs to be an adjustment of 150,000. So our journal entry would be loss on investments of 150,000 and credit the fair value adjustment for 150,000. So as it relates to the financial statement presentation for our equity securities, so equity securities, when the investor does not have significant influence, is either classified as current, short-term, or non-current, long-term in the balance sheet. So those that are held with an intent for short-term profit, then it's normally treated as operating activities. In the event that it will be held for the long term, it's classified as investing activities on the cash flow statement. So as it relates to the notes to financial statements, they should disclose the portion of unrealized holding gains and losses for the period that they relate to any equity securities that's still held by the company at the end of the reporting period. So the notes, they also need to provide information about how the carrying value was calculated, right? In such cases, when the fair value is not readily determinable. So when the investor has significant influence, then you utilize what's called the investment or the equity rather method. So significant influence, that's when the investor owns between 20 to 50% of the investee's voting shares. So what does significant influence mean? Then obviously decisions can be swayed in the direction that the investor desires because they have significant influence. And again, the key percentage is between 20 to 50%. So in such case, the investment is accounted for by using the equity method. So here we have an example. It says on 1/2/20 year 24, United Intergroup purchased 30% of Argent Inc.'s common stock for $1.5 million, $1,500,000 cash. So in order to see how the equity method works, we'll look at this illustration. So in this illustration, we assume that United Intergroup purchased 30% of Argent Inc. And again, because it's between 20 to 50%, they are considered to have significant influence. So buying 30% of Argent for 1.5 million, that implies that the full 100% fair value of Argent is 5 million, right? So how do we get that? 5 million multiplied by 30% equals 1.5 million. But keep in mind that the book value of the assets is only 2.1 million. How do we determine? It lets us know there. So a question might be, why is there a difference between the fair value and the book value? So here we see the fair value of 5 million and 2.1 million. So part of the difference, is that sometimes the fair value is greater than the book value. Why? Because assets are always recorded at its historical cost, and then you also recognize depreciation and things of that nature. So what we'll essentially see is that under the equity method, the amounts are shown in a single investment account, but you essentially need to track the individual information in order to calculate them correctly. So again, this is how we determine the 5 million. 500,000 multiplied by 30%, which equates to the 1.5 million purchase price. There's 10-year remaining for the useful life. There's no salvage value. And then we have other identifiable net assets, which is essentially other assets minus total liabilities. So in this example, we're recording United's purchase of 30% of Argent. It's pretty straightforward. Our journal entry would be a debit to investment in equity affiliate for the 1.5 million. And then we would credit cash for the 1.5 million. So again, pretty straightforward. So now in this example, we are essentially accounting for, the journal entry that needs to be recorded. So under the equity method, the investor includes in net income its proportionate share of the investee's net income. So in this case, we see for 2024, the net income is $500,000. Again, we own 30%. So 500,000 multiplied by 30% means that we recognize investment revenue of $150,000. So if, let's just say, we needed to record a net loss, then we would essentially have to reduce the investment, right? So here we have an example. So because we recognize investment revenue when net income is recognized by the investee, we won't have to recognize it again when dividends are distributed, because that would be like double counting it. So instead, whenever there's a dividend distribution, it basically reduces the investee's net assets. And what will happen is that we debit the cash that's received, again, $250,000, multiplied by the 30% gives us $75,000 in cash. And then what we would do is credit the investment in equity affiliate to reduce. So the rationale behind it is that the investee is basically returning assets to investors in the form of cash payments. So each investor's equity interest in the remaining net assets, it declines proportionately. So under the equity method, as we account for, further adjustments, whenever the investor's, expenditure to acquire an equity method investment exceeds the book value of the underlying net assets, there's some additional adjustments that need to be made. So the purpose is basically to approximate. We want to determine what's the effects of consolidation without actually consolidating the financial statement. So again, once the investee has control, or the investor rather has control, that's above 50%. So we want to account for that. Next, we amortize the differential between the purchase price and the book value. So we adjust the investment account and investment revenue to act as if consolidation procedures had been followed. So one key thing to keep in mind as it relates to consolidated financial statements, they basically report A, the acquired company's assets at their fair values on the date of acquisition, rather than the book value on the investee's balance sheet, and then B, goodwill for the excess of the acquisition price over the fair value of the identifiable net assets. So why does this matter? This matters because increasing the asset balances to their fair value, it basically results in higher expenses in the future. So let's say, if it's land or if it's goodwill that's increased, there's obviously no income effects because we don't depreciate or amortize land or goodwill. But on the other hand, let's say, it's property, plant, and equipment. It's a building, it's equipment, or some other depreciable asset. Then depreciation expense is going to be higher. Obviously, the higher expense that has an inverse effect on net income. So in this example, we look at some explanations for differences between the investment and the book value of net assets acquired. So in our example, United is basically going to need to make adjustments for the fact that at the time that they purchased the investment in Argent, the fair value of Argent's identifiable assets and liabilities were higher than the book value of those assets and liabilities. So this illustration basically shows United's 30% proportionate share of the amounts that were previously shown. So the net assets of 5 million multiplied by 30%, which is 1.5 million. The fair value of the investee's identifiable net assets, which is 3.6 million, multiplied by 30% is 1,080,000. And then the book value of the investee's identifiable net assets is 2.1 million, multiplied by 30%, which gives us $630,000. So this is basically an example. Again, we're still under the equity method, and this represents the journal entry that needs to be recorded when Argent determines its net income. It bases depreciation expense on the book value of its buildings on its own balance sheet. But United, on the other hand, needs to depreciate its share of the fair value of the buildings at the time that it made its investment. So we basically account for this higher amount of depreciation expense. And then United is basically going to have to reduce its investment revenue as if Argent included the additional expense in its earnings. So we would debit investment revenue for 30,000 and credit investment in equity affiliate. So as mentioned, United is not going to make any adjustments for land or goodwill. So land, unlike buildings, it's not an asset that we depreciate, right? So as a result, the difference between the fair value and the book value of the land, it's not going to cause higher expenses. So we don't need to adjust investment revenue or the investment in Argent stock for the land. So goodwill is basically an intangible asset. It can't be amortized, right? So when you hear the word goodwill, it's basically like the reputation of a company. So a great example, sometimes, we hear of companies like, let's say Apple, for example. Let's say Apple, they are, exploiting individuals that live in, third world countries to manufacture phones. If persons that are buyers of these products, they hear about it, they probably going to say, hey, you know what, we want to boycott Apple. And based on this new information, the value of Apple decreases because there are people that's buying it. So the goodwill, the value, the reputation of the company decreases. So with goodwill, again, it's an intangible asset. It's not amortized. So goodwill is basically like land. So therefore, if they acquire goodwill, it does not cause higher expenses. So ultimately, there's no need to adjust the investment revenue or the investment in the stock. So if the fair value of purchase inventory exceeds book value, then the period in which the inventory is sold should be identified. Inventory is usually sold in the next year. And any investment revenue in the investment in the stock, it would be reduced in the next year by the difference that's attributable to the inventory. So the fair value of investment shares at the end of a reporting period, it's not reported when using the equity method. So the investment account is reported at its original cost. And this is basically increased by the investor's share of investing net income. And then from there, it's adjusted for additional expenses like depreciation, and it's decreased by the portion of those earnings that's received as dividends. So in this example, again, we see the initial cost plus the investor's equity and the undistributed earnings of the investee. So the balance for United's 30% investment is calculated as follows: the purchase price plus the share of income decreased by the $75,000 in dividends, and decreased by the depreciation adjustment. So hence, the ending balance in the investment and equity affiliate is $1,545,000. So obviously, this is a bit more simplified than what you would see in a profession, but for the most part, this gives you a good example. So sometimes it's not purchased at the beginning of the year. Sometimes it's purchased during the year, mid-year. So in such case, you only recognize the investor's share of the year's activity. So if they were to purchase the stock in Argent on October 1st, then it'll be 3 out of 12, 1/4 for each of the items. So whenever the investee reports a net loss, then the investment account is going to be decreased by the investor's share of the investee's net loss. And this is an example of the equity method investments on the balance sheet for AT&T. So we see it for years 2019 and for years 2018. So whenever there's a series of losses, or maybe there might be other factors that indicates that the fair value has declined to amount below the carrying value, let's just say that the decline is not temporary. They assume that this decline is going to be permanent, or it's going to be ongoing. In such case, the investor needs to recognize an impairment loss in net income, ultimately reducing the carrying value of the investment to fair value on the balance sheet. And then from there, the investor basically continues and they account for it under the equity method. So if let's say the conditions change to or from the equity method to another method. So there's no adjustment is made to the remaining carrying amount of the investment except to account for, let's say, a purchase or sale of shares. The previous method is discontinued and a new method is applied from then on. And the balance in the investment account serves as the starting point for the new method. So when an investment reported by the equity method is sold, if the selling price is greater than the book value, a gain is recognized. And if the selling price is less than the book carrying value, the loss is recognized. So one key thing to keep in mind as we look at this greater than and less than sign, one tip and trick to remember which sign is which is that the less than sign looks like a slanted L. So if we look at this looks like a slanted L. So that for you should be a reminder, an indicator that this represents the less than sign, and hence the opposite is the greater than sign. So for example, the balance of United's 30% investment in Argent at December 31st, 2024 is $1,545,000. United sells its investment in Argent on January 1st, 2025 for $1,446,000. So we debit cash for the $1,446,000. We credit our investment for $1,544,000, and the difference represents a loss on our investments reported in net income. So this is basically just a comparison of the fair value and the equity method. And again, the fair value through net income, this is when the investor does not have significant influence. This is when they own less than 20%. And the equity method is when the investor has significant influence because they own between 20 to 50% of the corporation. So with the fair value option, the equity method, companies can choose the fair value option FVO for significant influence for investments that would otherwise be accounted for under the equity method. So the company is basically making an irrevocable decision about whether they want to elect the fair value option, and they can make the election for some investments and choose not to for others. So some alternatives for bookkeeping. The investment is accounted for using the entries that would be used if the investor lacked significant influence and accounted for it at fair value through net income. And then they would basically record all the accounting entries during the period under the equity method and then record fair value adjustments at the end of each period. So here we see a difference between US GAAP and IFRS. So like US GAAP, international accounting standards requires that the equity method for use with significant influence investees, which they are referred to as associates, but there's a few key differences. So one here we see is that under international accounting standards number 28, it requires that investees need to adjust to correspond to the accounting policies of the investor when applying the equity method. And IFRS, they do not provide the fair value option for most investments that qualify. So again, there's always some key differences between US GAAP and IFRS. So as it relates to financial instruments and investment derivatives, a financial instrument is defined as one of the following. It can be cash, it can be evidence of ownership in an entity, a contract that imposes one entity an obligation to deliver cash, or another financial instrument and conveys to the second entity a right to receive cash. It can also be a contract that imposes one entity an obligation to exchange financial instruments on potentially unfavorable terms. And B, conveys to a second entity a right to exchange other financial instruments. So some other investments might be special purpose funds. So it's often convenient, for companies to basically set aside money to be used for a specific purpose, right? So a special purpose fund can be established for any purpose, right? So something like petty cash, or maybe there's special funds that serve longer term needs. They're reported as non-current assets. So non-current special purpose funds, they're reported within the category investments and funds. There might be investments in life insurance policies. And companies, they very often buy life insurance policies on the lives of their key officers. So under normal circumstances, the company, they paid a premium for the policy and they're basically a beneficiary. And whenever the officer dies, obviously the corporation would receive the proceeds. So the objective is basically to compensate the company for the loss of a valuable resource in the event that the officer dies. So from there, we need to, account for the cash surrender value. So this is an example of how a corporation would account for cash surrender value. So we see here it states several years ago, American Capital acquired a $1 million insurance policy on the life of its chief executive officer, naming American Capital as beneficiary. Annual premiums are $18,000, payable at the beginning of each year. In 2024, the cash surrender value of the policy increased according to the contract from $5,000 to $7,000. The CEO died at the end of 2024. So in this example, this is our entry to record the insurance expense. And the increase in the investment is shown above. So we credit cash for the $18,000 because, that's the annual premium. And then from there, we see that there was an increase, in the value. So we recorded the increase in investment, which is the difference between the cash surrender policy, which was initially $5,000, increased to $7,000. So we increase the cash surrender value of the life insurance, and from there we debit the insurance expense. So when the CEO dies, we're going to receive $1 million. That represents the premium, the death benefit. So we debit cash for $1 million. We credit the cash surrender value of $7,000. And from there, we see that there's a gain on the life insurance settlement of $993,000. So this is our journal entry to record the proceeds at death. So one key thing to keep in mind is that the cash surrender value is basically considered to be a non-current investment, and it will be reported in the investments section on the balance sheet. So basically, when the insured officer dies, the corporation is going to receive the death benefit of the insurance policy. And then from there, the cash value is basically going to cease to exist. So you can't, necessarily cancel the policy. So therefore, the corporation is going to recognize a gain for the amount of the death benefit, which is 1 million in this case, less the cash surrender value, which is 7,000 in this case. Hence, we recognize the gain of $993,000. All right, so we basically look at credit losses for held to maturity investments. So companies recognize credit losses for held to maturity investments the same way that they recognize bad debts for a note receivable. They use a contra asset account, an allowance for credit losses, to basically reduce the carrying value of these held to maturity investments to reflect the net amount that's expected to be collected in each period. They basically record whatever credit loss, expense, or recovery of credit loss is necessary to adjust the allowance to its appropriate balance. So with the CECL model, it allows companies to choose from various methods. Again, the key thing is they want to estimate the credit losses for our held to maturity debt investments. So one of the common approaches is to estimate the future cash flows that they expect to receive, and then discount those cash flows at the effective interest rate. And then the investor might compare the discounted cash flow estimate to the balance, the amortized cost, or the carrying value. And then from there, they would adjust the allowance for credit losses and ultimately reduce the carrying value of the debt to reflect the estimate. So here we have this example. We're basically modifying Masterware's Industries example to demonstrate how we would account for credit losses for a held to maturity. So in this case, we see the amortized cost of the bonds at 12/31 is $671,297. We account for the interest, we account for the principal, and we see that the total discounted cash flow is $550,800. So from there, there's a difference of $120,497. So in order to account for this, the journal entry would be accounted for as follows. They would debit the credit loss expense and credit the allowance for credit losses. So United's 2024 before net income is going to be reduced by the $497,000 on a credit loss, and then the investment is going to be reported in the balance sheet at the carrying value of $550,800. So in future periods, United will basically re-estimate the discounted cash flows, and then from there, they'll make the necessary allowances, either to increase the carrying value or to decrease. So same facts, but this is if it is an available for sale investment. So again, same thing we need to account for. Amortized cost is $671,297. Based on the calculations of the interest and principal, the total discounted cash flow is $486,276. So we account for the unrealized loss because, again, we already had a credit loss from the held to maturity illustration. So therefore, there's a non-credit loss of $64,524. So here there's this decision tree to account for the impairment of available for sale security as follows. So we saw from the previous example that the fair value estimated could basically differ from the value that we use to calculate the credit loss. So we basically have like this flow chart. So is the fair value less than the amortized cost? If it's no, there's no impairment. We basically recognize any unrealized gains in other comprehensive income. If the answer is yes, the fair value is less than the amortized cost. The question is, all right, well, does the investor intend to sell the investment? Or is it more likely than not that the investor is going to have to sell it before the fair value recovers? If the answer is no, we need to ask, is some of the unrealized loss a credit loss? If the answer is the investor does intend to sell it, then yes, we recognize the entire unrealized loss in earnings and reduce the amortized cost to fair value. So again, This is the flow chart. These are things to consider with how they're going to account for any impairment of available for sale securities. So in this example, if United intends to sell the bonds, or they think that they're going to sell the bonds before the fair value records, the journal entry as follows. They debit loss on impairment for net income, and they credit the discount on bond investment. In this case, if they don't intend to sell the investment and they don't believe that it's more likely than not that they'll have to sell the investment before the fair value recovers, the journal entry would be as follows. They would debit credit loss expense and credit allowance for credit losses. And then on December 31st, in addition, they would debit the loss on available for sale, unrealized other comprehensive income, and credit the fair value adjustment. So we could basically see that in both cases, United, they carried the investment at the fair value. The difference, however, is how the impairment loss is going to be reported. So for case one, the entire impairment loss is basically going to reduce the current period earnings. But in case two, as we have on the screen, only the credit loss reduces the current period earnings. So under COVID-19, obviously there were, several changes. So the Coronavirus Aid, Relief, and Economic Security CARES Act was designed to provide stimulus relief to businesses affected by COVID-19 in the form of loans, grants, and tax changes. So this is basically just letting us know that in Chapter 7, it is discussed that the CARES Act included a provision that enabled banks and some other financial institutions to avoid having to adopt the CECL approach, and that's between March 27, 2020 and December 31st, 2020. And this delay was intended to enable banks to avoid recognizing large losses on outstanding receivables that they would have to recognize if they applied CECL. In addition, CECL also required considered forward-looking information that, what will happen after COVID. So lastly, we, just look at some differences as it relates to impairments, US GAAP rules versus IFRS. So under IFRS number 9, companies, they recognize impairments for debt investments that are accounted for at amortized cost versus under GAAP, where it's reported, fair value through net income or at fair value through other comprehensive income. So the impairment is calculated using the ECL model, the expected credit loss model, as we discussed previously, and they measure it either as a 12-month expected credit loss or the lifetime expected credit loss if, they assume, or the credit risk rather, has increased significantly. So just keep in mind, as you are moving through these chapters and, just looking at accounting in general, you always want to determine, are there differences between US GAAP and IFRS if you need to apply these concepts to an international company. So that brings us to the end of chapter 12, where we essentially covered debt investments and security investments in corporations.